This is Nightly Business Report with Bill Griffith and Sue Rivera.
Hiring rebounds. June was a hot month for job creation. But what's good for Main Street may be keeping Wall Street on edge.
Amazon at 25. The company disrupted entire industries and changed our day-to-day lives. But the next quarter century could look very different.
Show me the money. Filing for financial aid can be daunting. But one entrepreneur is helping families negotiate and lower the cost of college. Those stories and more tonight on Nightly Business Report for Friday, July 5th.
And we do bid you a good evening, everybody, and welcome. Well, the labor market came roaring back in June following that weak job growth we saw in May. The Labor Department reported this morning that the economy added 224,000 jobs last month, far more than expected. The unemployment rate ticked higher to 3.7%, in part because more people entered the labor force. But that number is still historically low. And while this latest jobs report is clearly positive news about the economy, it may make it harder for the Federal Reserve to cut interest rates at its meeting later this month. And that sentiment pulled stocks back from their all-time highs that we hit on Wednesday. Dow Industrials fell 43 points to 26,922. NASDAQ was down 8. The S&P slid by 5. Ilan Mui has more on America's employment picture from Washington.
America's job market is once again red hot. It even surprised President Trump.
We had great numbers this morning. I think it was 224,000 jobs. Those were really unexpectedly good. And our country continues to do really well, really, really well. So we're very happy about it.
Businesses across almost every sector of the economy added jobs last month. Professional services added 51,000 jobs. Healthcare rose by 35,000, and manufacturing was up 17,000 jobs. But that good news may have been bad news for Wall Street. The Federal Reserve is expected to cut interest rates later this month. Investors are worried that a strong jobs report could stay its hand.
I think the market will be really upset in terms of valuations. I think people will be asking, why aren't they cutting? What is going on here? Because it doesn't appear that the overall economy is picking up.
The job market is so strong, the president said it's getting harder to recruit workers to the military. The unemployment rate for veterans was 3.2% in June, and for the past year, it's hovered at the lowest levels in nearly 2 decades.
Military personnel are unique in that they are taught and groomed from day one of basic training or boot camp to essentially be the best of the best, to be masters of their trade regardless of in what capacity they serve, what their MOS was, what their branch was.
Hundreds of veterans attended this recent job fair in Maryland, where about 70 organizations were hunting for fresh talent.
It's been good. I was a little nervous at first, but I mean, just got to get over that and get some confidence, and it just kind of gets the ball rolling. And just get bounced from different person to different person.
Fed Chairman Jay Powell will be testifying on Capitol Hill next week, and investors will be watching closely for any hints that the central bank will be changing course. For Nightly Business Report, I'm Ilan Mui in Washington.
More now on the jobs report. We turn now to Chris Rivera for more analysis on the report. He is the co-head of U.S. economics at Macroeconomic Advisors by IHS Markit. Welcome, Chris. Nice to have you here.
Good to be here.
So we had pretty solid growth and wages increased at a pretty decent level. What did you think overall of the report?
Yeah, very solid. Not really anything in the report not to like. Good growth in private employment. Overall job gains were good. Government employment was up a lot. Unemployment rate ticked up a bit, but that's just because there were so many new folks flooding into the labor force. So overall, a very solid report. Not much to be disappointed in.
But of course, the elephant in the room with this report is the Fed and what it will do about that. If I understand your position correctly, you don't think they need to cut, but you think they will anyway. Why?
Yeah, absolutely. So we think the economy is still on pretty solid footing. The Fed's pivot is a lot about focusing on downside risks and, playing that risk mitigation strategy. But yeah, we think the economy would do fine without a rate cut. However, the markets and Fed speakers have certainly sort of pushed everybody to expect a rate cut. As you know, even the possibility of a 50 was on the table there for a bit. So Yeah, they'll probably go ahead, although it's not a foregone conclusion. And if they, for some reason, decided not to go ahead, we think the economy would do just fine this year and into next year.
Our economy may be doing fine, and this does show some pretty slow, steady, solid growth. But the global economy, there are some hot spots out there, and we still do not have a trade deal with China.
Yeah, to be sure. I think those are the two major areas that everyone is focusing on as potential, traps that the economy can fall into. The thing with trade, it's really tough. There's a lot of uncertainty. Businesses don't know if there's a trade war, whether their industry will be subject to countervailing tariffs. So that certainly casts a pall over decision-making for businesses, whether to invest. That is a problem. And of course, the weakness abroad is an issue as well. It's something to be watching very carefully. But again, at this point, it's a downside risk, not necessarily needing Fed.
All right, Chris Rivera with Macroeconomic Advisors by IHS Markit. Thanks again for joining us tonight.
And as Elon just mentioned, Fed Chair Jerome Powell will indeed be delivering his semi-annual economic report to Congress next week. The printed version of that report was released today, and in it, the central bank said the economy was growing at a solid pace. But it also noted that growth likely weakened in recent months as higher tariffs slowed global trade. And once again, the Fed pledged to act as appropriate to sustain the economic expansion.
And to that other big market issue, that would be trade. China appears to be renewing its demands, and there are reports now that the country is questioning some of the promises made by the U.S. Eunice Yoon reports for us tonight from Beijing.
A Chinese state media blog says that China won't buy American crops if the U.S. flip-flops in the trade talks. The Taoran Notes blog, which is associated with the Economic Daily and believed to have insights into Beijing's negotiating strategy, posted a commentary today saying, if the U.S. flip-flops in the negotiations, the promises to buy American agricultural products will also be overturned. The piece comes after the Hong Kong newspaper, the South China Morning Post, quoted sources as saying that China is putting off buying American soybeans to gauge first how the White House eases restrictions on national tech champ Huawei. On Thursday, the Commerce Ministry flagged Beijing's concerns that the U.S. might not make good on what the Chinese see as President Trump's promise. The ministry said U.S. companies should be allowed to sell to Huawei right away. In addition, the ministry stressed the importance of one of Beijing's previously stated preconditions to a deal, that all imposed tariffs should be lifted. The U.S. Trade Representative's office says that the two sides are working to arrange a phone conversation for the top negotiators as early as next week, with the fate of Huawei quickly moving up to the top of the agenda for the Chinese. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Believe it or not, it has been 25 years since Amazon launched as an online bookseller. And today, of course, it is the largest e-commerce retailer in the U.S., and it made its founder, Jeff Bezos, the world's richest man. But the next 25 could take the company in a new direction. Deirdre Bosa has more.
25 years ago today, Jeff Bezos filed paperwork to create what was originally called Cadabra Inc. Now, Amazon, a household name, the company has disrupted entire industries, from publishing to retail to cloud computing. It's also become one of the largest companies in the world. Today, it's worth close to $1 trillion in market value, second only to Microsoft. The next quarter century, though, is likely to look very different. Amazon is making big moves in a number of new industries. Groceries with its acquisition of Whole Foods in 2017, healthcare with its PillPack purchase and joint health venture with JP Morgan and Berkshire Hathaway. There's also advertising, smart homes, even ironically, brick and mortar with its growing physical footprint of bookstores, convenience stores, and pop-ups. But as Amazon sets out on its second quarter century with more ambition than ever, the company is facing more scrutiny and criticism than ever.
You know, historically, Europe's talked about competition in the market. The U.S. has talked about harm to consumers, but the Justice Department's now starting to talk about, well, it's not just, okay, your prices are low, it's do we really have a competitive market? So I don't think what's happening in Europe, other than a short-term dislocation, will have a lot of impact. I think what's going on in the U.S. longer term could be more interesting.
More antitrust scrutiny around the world could make it difficult for Amazon to grow as quickly as it has over the last few decades. It could even turn the tables and disrupt Amazon's own structure, as lawmakers like Senator Elizabeth Warren call for a breakup of big tech.
So my view on this is it's a little like baseball. You can be an umpire, a platform, or you can own teams. That's fine, but you can't be an umpire and own one of the teams that's in the game. So the principle here is break those apart, and you can work for the platform part, you can work for one of the teams, that's a lot of fun. But if you work for one of the teams, you compete like every other team in America.
Far from its beginnings as an online bookstore, Amazon now begins its next chapter as one of the largest and most influential, yet controversial companies in the world. Nightly Business Report, Deirdre Boza.
Still ahead, school's out for summer, but where are all of those young workers?
I'm Kate Rogers in Asbury Park, New Jersey, and tonight on Nightly Business Report, we're talking teen jobs. Who's working, who's not, and why.
And more on the jobs market and a new labor problem facing businesses. Employers are finding it increasingly difficult to hire teens, even during the summer months. Kate Rogers is in Asbury Park, New Jersey.
Hi, what can I get for you today?
Janiyah Hill is kicking off her second summer working at Pucker Lemonades and Beach Fries in Asbury Park, New Jersey. The 16-year-old is making $10.50 an hour, 50 cents above the state minimum wage, working the register and serving up cold drinks and fries to customers on the boardwalk.
Well, when I'm not in school over the summer, I like to keep myself busy. I want to have a job. I want to work. I want to have my own money.
Hill may enjoy working, but the share of teens working or seeking work in June, July, and August have been stagnant in recent years. The labor force participation rate for teens in summer last year was 40%. 10 years ago, it was closer to 50%, and in the late 1990s, 60%. At the same time, the number of teens enrolled in summer courses has gone up significantly. In 1985, just 10% of teens took courses in July. Last year, that number was at 45%. And while preparing for college is important, experts say so too is having that first job.
We hear a lot of conversation about being college ready. We don't hear a lot of conversations about being work ready. You can only learn so much in a classroom about how to actually work. In many cases, those first jobs are really important at teaching skills that supplement classroom education but can't replace it.
Whether it's summer courses or other extracurricular activities, franchisee Mike Haynes says he's seen a shift in the availability of teen workers at his 4 tropical smoothie cafe locations in the Atlanta area.
They're doing things like volunteer work. They're engaged in their churches, whether it's volunteering there. They're looking at their extracurricular activities. They're taking additional summer courses, whereas previously the labor pool for summer students would have been much higher. Now we fit a little bit differently in the mix.
In fact, he says in order to remain flexible with teen scheduling, he's getting creative, hiring more workers. Meanwhile, Hill's boss, Anthony Bannon, says he's shifted his recruiting tactics as well, bringing younger workers into the fold as older teens became less available.
And we found over the last couple of years, as 15, 16, 17-year-olds aren't working as much, we've had to actually open it up to 14 and 15-year-olds using programs like working papers and working with schools. So we've had to expand that age range a little bit.
As teen worker availability shifts, so too do recruiting and retention tactics at businesses. For Nightly Business Report, I'm Kate Rogers in Asbury Park, New Jersey.
Samsung warns its second quarter profit could be cut in half. And that's where we begin tonight's market focus with the world's largest smartphone maker and supplier of memory chips, citing a slump in demand for its semiconductors. Analysts say that the problem was exacerbated by the U.S.-China trade dispute. Samsung doesn't trade here in the U.S., but the warning did pressure some rivals that do. Micron, Intel, and Broadcom were all lower in today's trading session. Barrick Gold, Newmont Mining, and other gold stocks fell on the stronger than expected jobs report today, which many believed lowered the chances of a Fed interest rate cut. That raised the value of the dollar, which in turn pressured gold, and that sent the gold shares lower, down a fraction for Barrick to $15.80. Newmont shares also fell to $38.42.
And shares of mining company Rio Tinto and BHP fell on a report out of China. Authorities in that country are reportedly concerned and looking into the recent increase in the price of iron ore. Rio Tinto shares were down more than 5% to $60.05. BHP was down nearly 4% to $56.61. Alexion Pharmaceuticals said the European Commission approved marketing for its drug used to treat a rare blood disorder. That drug has already been approved by the FDA. Despite that, the stock dropped more than 2% to $130.30.
Time now for our weekly market monitor, who this week has some names of 3 high-quality, large-cap stocks that also pay a dividend. Barry James is back with us. He's president and portfolio manager at James Investment Research. Always good to see you, Barry. Thanks for joining us tonight.
Glad to be with you.
Let's start with Molson Coors. I'm interested in this one. Here's a stock that's lost roughly half its value in the last couple of years with all the competition from those small craft brewers. Why do you like this company still?
Well, there's a lot of things to like about the company. First of all, they're really cheap. They're trading at a price that's less than what the accountants say it's worth. So that's one thing. And compared to others in its field, it's much cheaper. They have been paying back their debt, so they're very strong financially right now. And if we do see a slowdown in the economy, that's generally pretty good for beer makers. And they have expanded into a lot of the craft area. Some of the names, are pretty weird, some of the brand names that they have in their stable. But nonetheless, they're taking the challenge head on.
And next is in the finance sector, insurance company Travelers. Why do you pick this one?
Well, it doesn't have any effect from China trade. That's one of the things. It's all done here, and it is really helped by interest rates dropping. So much of their portfolio is invested in bonds that is obviously a benefit. They've got a bit of a yield, and they've been buying back shares. So there's a lot of positive things there for the company. And in this type of environment, we think it's good to have something that's somewhat defensive, like a Travelers Insurance.
And then finally, Verizon. I'm guessing that 4+% dividend yield is one of the first places you start at right now.
I hope that isn't the bait that gets you hooked.
Right.
And an unfortunate event happens after that. But again, they're just a cash machine, over $18 billion in free cash flow. They can do just about anything, buy anything that they want, as it were. And people have stacked up their bills and they say, number one, I'm paying my cell phone. Not food, not credit cards, it's their cell phone. So they're in a very good position as far as that goes. And with some consolidation in the industry, that works to their benefit as well.
Very, very quickly, Barry, the overall market, how do you feel about it?
I think it's pretty risky right now. People are kind of, they have a trifecta of anticipation: lower interest rates from the Fed, a rebounding economy, and China trade. But the one thing that really worries me, 80% of the stocks are now controlled by machines.
Right.
60% in index funds and 20% in quant funds. And so they're buying just because they exist, not because the earnings are good. And we've seen companies with no earnings go up more than companies with earnings.
Right.
Again, doesn't make any sense. That's risky, so be careful.
Barry James with James Investment Research. Again, thanks for joining us tonight, Barry.
Good to be with you.
It has been a tough week for Electronic Arts. The video game maker released Season 2 of Apex Legends, and expectations were high. But initial viewership numbers were considered disappointing, and that sent the stock lower for the week and is putting renewed attention on its competition. Josh Lipton has more.
Apex Legends launched with a bang in February. The free-to-play game from Electronic Arts quickly attracted 50 million players. the new season of the game officially launched with a new character, new weapon, and what are called new skins, meaning new costumes for the characters. EA executives say that Apex Legends is the fastest growing new game the company has ever had, and they think net bookings or adjusted revenue from the game could be as much as $400 million in fiscal 2020. But for all the hype, analysts say their checks indicate that the initial fervor surrounding the game cooled. In part, that's because the company didn't update the game as quickly as the competition, meaning this game, Fortnite, another free-to-play battle royale game and a giant in this market. Fortnite has racked up 250 million players and nearly $4 billion in estimated revenue. The game is free-to-play but earns money when gamers make in-game purchases for items like weapons and costumes. So the question now is whether EA can spark renewed interest in Apex Legends with this new season and give the stock, already up some 30% this year, a lift. Some analysts are hopeful, but they also point out that there doesn't have to be just one winner with this style of game, that Apex Legends and Fortnite can and do appeal to different demographics. So which publicly traded game publishers can capitalize on this trend? Analysts say EA is well positioned, but they believe Activision could make a strong move in this market too, perhaps offering a version of its popular Call of Duty game as a free-to-play title as well. For Nightly Business Report, I'm Josh Lipton, San Francisco.
And coming up, looking to cut the cost of college? Meet one entrepreneur who wants to make sure no money is left on the table. Student loan debt now stands at $1.6 trillion and counting. And as we have been reporting, it affects career choices, home buying prospects, even marriage rates. Yet an estimated $40 billion in financial aid resources goes untapped every year. And that's why a 20-something New York City entrepreneur got the bright idea to find a better way to match students with those aid programs, and it's for free for users. For most, the free application for student financial aid, or FAFSA, is complicated. Even with an MBA, David Holder has his own set of adjectives.
It was quite daunting. It seemed like it was never ending. It was a bit challenging. It took a couple days.
More than a third of eligible students don't bother completing the 100-plus questions that FAFSA asks. They're missing out, not only on federal grants, loans, and work-study jobs, but also aid from states and individual schools. Holder's daughter, Delaney, an incoming freshman at the University of Pennsylvania, saw her friends struggle with it too.
A lot of my friends really didn't know what they were doing. It was something so painful. My mom still complains about it.
That's why Charlie Javis and her team built a site called Frank.
If there could be a technology solution where you did not need to be financially literate to actually file this form, that would be a success.
They worked in person with Bronx students back in 2016, learning enough to launch the site in the spring of 2017. In just 1 month, 10,000 students flocked to Frank and filed FAFSAs. A little more than 2 years later, 500,000 Frank users have secured more than $7 billion in aid. The site helps them prevent a lot of common mistakes, which can drive up their debt.
List whatever's the minimum in your account. If not, you're doing yourself a disservice.
Despite the early traction, Frank's path to revenue wasn't immediately clear. But as tech companies often learn, the answers lie in the data.
Schools are having a really challenging time when it comes to enrollment today. So we started building a feature that would recommend a good match for them to send their FAFSA to.
Many who need aid apply to only 1 or 2 schools, but Frank helps them cast a wider net.
Little did we know a few months later, it could also be valuable to schools where they said, wait a second, can we play?
Now, about 2,000 schools are paying Frank to help them find students who fit both their academic communities and their financial aid guidelines. Frank won't say how much they pay for access, only that it can make up a significant amount of marketing budgets running well into 6 figures per month. But Frank's core is the free FAFSA service.
I was like, oh my God, this is extremely complicated. I don't know what to do.
Frank can help students like Enmi Blanco from the Bronx navigate details like figuring out adjusted gross income versus straight salary, or excluding real estate and 401ks from liquid assets. Blanco turned to Frank before her junior year in college, completing the application in minutes.
It tells you take line 58 from the income tax, subtract line 57 from it, and then that's what you're putting here. The financial aid website does not do that.
They match you with a school.
David Holder wants that kind of help, not only for his daughter, but also younger brother Jeremiah, who's likely headed to college in 3 years.
A one-stop shop place, if there is one, that would be extremely helpful.
And that, quite frankly, is what Charlie Javis is hoping to accomplish. By the way, Frank also offers non-FAFSA financial advisory services for less than $20 per month. The annual deadline, by the way, to complete a FAFSA just passed on June 30th, but it does open again for the 2020 school year on October 1st.
And before we go, here's another look at the final day's numbers on Wall Street. The Dow, 43 points to the negative side. The Nasdaq was down 8, and the S&P 500 slid just a little bit more than 5. But all of the major indexes were higher for the week. And that does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Bill Griffith. By the way, we apologize for the technical issue with our guest earlier, but that happens sometimes in television. Have a great weekend. See you Monday.